Hey everyone, this is Paras Chopra, and today I'm with Lyn Alden, who's an engineer deeply in love with finance. She runs an investment research service for institutions and individuals and she writes a lot of research and reports at her website, lynalden.com. Her interest is in value investing, but she looks at it from a global macroeconomic point of view. She's mostly interested in equities, but she's asset agnostic. So if you go to her website, you'll find analysis about precious metals, debt instruments, and lately she's been interested in cryptocurrency as well. Over a period of time, Lynn has been thinking about US dollar and the role it plays in the world economy and the future of US dollar generally. So I thought it'll be great to chat up with her and pick her brains on what future looks like for dollar. She believes it is going to weaken in the future. So 2020 looks like a weakening of US dollar because of this phenomenon called Triffin's dilemma. So we'll explore a lot of things. In fact, we'll start from the basics. And it's going to be an interesting podcast about basically how the world macroeconomic view looks like from Lynn's point of view in the coming decade. So welcome, Lynn.
Hey, thanks for having me. Glad to be here.
Fantastic. So, Lynn, I was curious. You're an engineer. So, let's just start with that. How did you become interested in finance? I think a little bit of background and context about that would really set a good understanding for the upcoming conversation.
Sure. I mean, actually, the funny thing is, I was in finance in some ways before I was an engineer, and so I started investing. My first investments were in precious metals when I was a kid, and then I shifted into equities when I was a teenager, and that was just always fascinating to me. And I think there's a variety of reasons for that. I kind of grew up in poverty, and when I kind of got some degree of stability in my life, I started focusing on. I became interested in building wealth, building stability, and kind of just understanding how the economic system works. And so, for whatever reason, I guess combined with the fact that I was inherently kind of mathematical, the idea of exponential compounding appealed to me, and so I started that journey early on. But when it came time to go to university, I also had an interest in technology, and so I just kind of went that way professionally at first. And so I went into electrical engineering, and then I worked in the aviation research industry and the industrial automation industry. And so I lead like a facility, the day-to-day operations of it, and so I've run the finances of it. But on the side, I started doing research like over a decade ago on investments for mostly for individuals back then, mostly focusing on dividend stocks and things like that. But in 2016, I launched Lyn Alden Investment Strategy to have a more professional, investment research service that can appeal to both institutions and individuals, and covered a range of different assets. And so it's kind of that marrying of both, the engineering side to some extent, but also my lifelong passion for finance.
It's interesting. I mean, you were into investing in finance first, and then you went on to do engineering. Uh, I've heard the most common path is people out of sciences and engineering go into investing. It's uh, so, Lynn, I did want to start from basics. When we talk about US dollar being a global reserve currency, what does a reserve currency really mean?
Yeah, so it's actually funny because the definition of reserve currency has somewhat changed over time. And so people often refer to previous reserve currencies, but they actually worked in a very different way than the dollar works now. And so, back in history, the really the reserve currency was gold essentially. There each country would have gold reserves, and then they'd have paper issued against that gold, and it's kind of representing gold. It's a more freely exchangeable certificate for gold. Essentially, that's how most currencies worked. But of course, some of them, due to military dominance and trade dominance, would be widely recognized. And so, you could have that currency be accepted not only in your own country, but also in many of the trading partners around the world. And so that kind of initiated the concept of a reserve currency. And now it started changing a lot in the past, 80 years or so. And so in 1944, at toward the end of World War II, countries agreed on the Bretton Woods system, which is that all basically the dollar would be backed by gold, and then most currencies would be pegged to the dollar at a fixed exchange rate. And so by extension, they would also be backed by gold, but not directly. And that really cemented the US dollar as the global reserve status in a stronger way than any previous one. Because, one way to describe it is that was the first time we had technology to have a truly global war and then a truly global monetary system that kind of came in its wake. Because everything else before then was really kind of continental or regional. It wasn't really kind of worldwide. And so from 1944 to 1971, we ran on the Bretton Woods system. But the problem is that the number of dollars in existence kept going up. And so that's because banks can multiply money when they make loans, and the U.S. government issued more treasury debts, and those are redeemable for dollars essentially, and then the dollars are redeemable for gold. And so especially if you look at the foreign official sector, because they're the ones that were technically able to convert those dollars to gold. Because if you were an American, you couldn't just take your dollars and redeem for gold during that period. It was actually illegal for Americans to own gold, ironically. But the foreign official sector, they could redeem dollars for gold, and a lot of them did that. And so what we saw was the United States went from having absolutely massive gold stockpiles, and they just kept going down over time because the amount of dollars in existence was just growing while our gold was fixed. We weren't really adding to it, and then we started drawing it down. And so those dollars became less and less backed by gold. And then some of the foreign actors began basically calling our bluff and saying, no, we want the gold. We don't really think the dollar is going to be able to be backed anymore. And so if you look in the very late 60s, that system started to break down. The amount of dollars outstanding compared to gold was just way too wide, because of course we were doing domestic, we were doing more fiscal spending, and then we were doing the Vietnam War, and so we had too much treasures out there, too much dollars out there to be backed by gold, and so that system broke in 1971. Nixon took us off the gold standard, but really it was all the issues, the years leading up to that. It wasn't like that was a decision made that year. That was really it was inevitable if you look what was happening in 68, 69, 70. And then the world entered this really unusual period where all currencies became fiat currencies. They became all just paper currencies backed by nothing because they were all backed by the dollar, and the dollar was backed by gold. So by erasing that lever, we kind of entered monetary chaos. And then in the 70s, we had the oil embargoes, right? So we had all these political events that created some commodity scarcity. And that was resolved in the mid 70s with an agreement between the United States and Saudi Arabia and other OPEC nations, where the U.S. would provide military protection and trade deals, and those countries would agree to only price their oil in dollars. And so regardless of who they're selling oil to, they only sell it in dollars. So of course, when they
Right.
sell it to the United States, they sell it in dollars. But when they sell it to France, they sell it in dollars. If they sell it to Japan, they sell it in dollars, which means that every country in the world that needs oil, which is virtually all of them, unless they produce it, they need dollars. And so
Right.
they can either sell their own products and service in dollars, or they can exchange some of their currency for dollars. But either way, they have dollar demand now. So the dollar becomes the de facto currency.
Right.
And what's interesting is that it's not just the medium of exchange anymore. It's literally the store of value. So central banks around the world held these treasuries in large amounts. And so that's really the system we've been operating under for 45 or 50 years.
Yeah. Yeah. So just to capture my understanding of a reserve currency, I was reading a bit on the whole evolution of gold-backed currencies to fiat currencies. So it really started from, say, central banks coming into existence. I mean, if we think about paper money, it was nothing but receipts for the gold that early forms of banks were warehousing. So if you had, say, 100 grams of gold, they would just issue receipts for 100 grams of gold, and that was literally the paper money. And eventually and gradually, central banks of nations took that role, wherein private banks couldn't warehouse gold. They had to necessarily, by law, had to give out all the gold to the central bank, and instead central bank would issue their paper notes, receipts, and that would be kept as a reserve currency for private banks, on top of which they would give loans. So in that sense, I mean, it's amazing how within a nation, a reserve currency does make sense, because uh, the central bank can keep on issuing more and more print money. But it's quite fascinating how even beyond borders, this concept of not just gold but dollar itself came out to be something that other countries' central banks would keep in reserves as a collateral or as um, just in lieu of gold. So it's that story is quite fascinating. And Lynn, I'd love for you to unpack that a little bit. How did sorry US dollar end up replacing, say, a hard asset like gold for most of the governments to hold in their reserves? How did this happen?
Yeah, so I think you articulated it well that it's really a problem if you're trying to get a foreign country to accept your paper. And so, it's easy to do it on your own citizens because you can say just by law, your taxes are only payable in this currency. And so that by definition, you made it so that everybody needs this currency. That's their unit of account. And so they can store value in other things, but at the end of the year, they have to reconcile in dollars or whatever the currency of the country is. Now, but it's really tricky to get a foreign sector, for a foreign sovereign nation to accept your paper in exchange for their oil or their cars or whatever the case may be. And so the earlier way of doing that was, as you said, basically the promise is that it's exchangeable for gold. And so it's kind of like saying, okay, it's not gold, but it's as good as gold. That's even like a narrative they use. It's that the dollar is as good as gold. And so it's kind of like it's just like gold, but it's more exchangeable. You can transport larger amounts of it because it's lighter. You can put it in a bank and get credit against it. It's basically just a kind of a technological innovation on top of gold, but I have this kind of receipt that moves around more freely. And as long as they trust that backing, that can work pretty well for a while because especially when you combine it with some sort of political might. And so, for example, in Bretton Woods, there were different factions. It's not like they all agreed on the Bretton Woods system. And so the UK position under Keynes was to have an idea of the bank war, which was that the global reserve currency would be this neutral asset, which would be called the bank war, and it would be a basket of multiple large currencies. And so that'd be kind of the unit of account between nations. And they could all, the central banks could hold units of those accounts, and therefore they, kind of the global reserve currency would basically be a mixture of all the major currencies. And there wouldn't really be any structural imbalances there. It would actually make a lot of sense mathematically. However, the other argument from the U.S. position was, no, let's just make the dollar the center of the system. And that had pros and cons because in the first couple decades, that would increase United States hegemony. That would increase our basically our empire status, our military might, our trade might. But the downside is that if everybody needs dollars and everybody holds dollars and there's tons of demand for the dollar, that makes the dollar pretty strong. And it also makes it so that we have to get a lot of dollars out into the world because if every country is going to buy their oil in dollars, they need, they need dollars. And so we have to have a lot of dollars out there for that system to work. We couldn't, for example, make the Swiss franc the global reserve currency because there's not enough out there. They wouldn't be able to use it. And so your country has to be sufficiently large and has to run really big trade deficits in order to get all those dollars out there. And so if you look at the long term, like, the 100-year history of the US trade balance, it was positive. It was in good shape. And then right from the mid 70s, when we did the petrodollar system, it just utterly fell off a cliff. And we've been in like a 45-year structural trade deficit ever since, because that goes back to Triffin's dilemma, that in order to be the world reserve currency, at least the way it's currently structured, where it's both a store of value and a medium of exchange, and it's only used to, and it's the only currency really that can be used to buy oil and commodities globally, that pretty much forces us to run structural current account deficits, trade deficits. And so we basically, if you go back to the Bretton Woods system, we drew down our gold over those decades to maintain that system. And what we've done over the past 45 years under the petrodollar system is that instead we've drawn down our manufacturing base. We've made our domestic manufacturing base far less competitive, not just against emerging markets, but also against Japan and Germany, because they haven't had a similar problem. And so we basically sacrificed our kind of making stuff here portion of our economy, and we've doubled down on our financial economy, our healthcare economy, our tech economy, kind of higher margin things, and we've really outsourced a lot of that industrial portion. And that's kind of the trade-off we've had to make in order to kind of maintain this empire status or this global reserve currency.
Right. I want to stick to this point in terms of trade offs, but I want to go one step back in the history where the trade off was really about gold. I mean, most of the currencies were pegged to gold, and slowly and steadily, those pegs came off and they became fiat currencies. So why did that happen? And Is that the world didn't have enough coal, or was it because there were just structurally different trade-offs wherein gold-backed currency just wasn't possible?
Mostly it's too much debt. And so, before any of those systems ended, even they were backed by gold, often what they would do is reduce their gold peg. And so in the United States, as an example, a dollar used to be worth like 1/20th of an ounce of gold roughly. But then in 1933, 34, they devalued it, so it was only worth 1/35th of an ounce of gold. And the reason they had to do that was basically to recapitalize the banking system. That was their version of QE back then. And so when you have a fixed amount of gold or a very slowly growing amount of gold, but then you have more and more dollars in the system because banks can lend it, banks can multiply it, fractional reserve banking. And then on top of that, if you have a very high debt to GDP ratio or a debt to broad money supply ratio, there's a lot of claims against those dollars. And this goes to Ray Dalio's long-term debt cycle thesis, which is basically that you have these short-term business cycles, they last 5 to 10 years, but that over time, interest rates keep getting lower and lower, debt keeps getting higher and higher. And there are ways that you could do that, but basically the government and the central bank would have to basically accept short-term pain in order for long-term stability. But for political reasons, they usually choose short-term gain and expense at the long term. And what eventually happens is that interest rates go all the way to zero, debt gets extraordinarily high, and there's kind of this forced deleveraging event. But because there's so much debt relative to money supply, relative to gold, relative to kind of these base assets, if that debt starts to unwind, it causes like a big deflationary spiral. It just keeps kind of because if you default on someone else's asset, if you default on a liability, that's someone else's asset, and if they have both assets and liabilities, and one of their assets goes up in smoke, now they're potentially insolvent, and then they might have to default on some of their liabilities, and that's someone else's asset, and you get this really cascading collapse. And so what we saw, for example, in the late 1920s, early 1930s, is that we started to have a big giant debt collapse. From really high debt levels, we saw something like a third of banks failed. There's no FDIC insurance, so money was just destroyed, and you had this kind of ongoing deflationary collapse. And many banks became insolvent. And so one thing they did was they revalued gold higher, because if banks back then, they were still holding gold as reserves, and so they had a certain amount of all of their deposits, their dollar deposits were their liabilities, whereas the gold was their assets. So by redefining gold to a higher dollar level, it kind of fixed their asset to balance ratio in a similar way that QE did in 2008, 2014. And so it's kind of this forced thing to do in response to a debt crisis. So the mistakes were not really the devaluation itself. The mistake was having the conditions that led to so much debt building up in the first place. It was kind of all those years preceding
Right.
it that kind of made it inevitable. And so this cycle goes back thousands of years, where you have these kind of multi-generational debt buildups. And usually the thing that ends up kind of paying the price for that is the currency, because they can choose really either a massive kind of default and reset, or they can choose to weaken the currency, and that's kind of a softer way of defaulting, and that's usually what politicians and people choose.
Right. So what you're saying is, imagine there is just a limited amount of gold, and your currency is backed by that gold in some ratio to keep the economy going, to keep multiplying the money for investment. At one point of time, it just becomes unsustainable because there is less gold than the money in the system. So when you start making claims for the gold, you simply cannot. You simply don't have enough gold. So, and that's where the devaluation as compared to gold happens. And at some point of time, it just becomes unsustainable, and that is the arrival of the fiat currency, right?
Yeah, at least the way we structure it now, the way we've structured it for about 100 years, that tends to be what happens. It's not necessarily inevitable. I mean, you can theoretically, there have been countries that have been able to maintain their currency strength for centuries. It's doable. It's just rare because it kind of goes against human nature. And so if you have a less debt-based system, if you have a more equity-based system, and you kind of have this cultural emphasis on the long term over the short term, it is possible to avoid that fate from repeating over and over again. But in practice, that's usually what happens is every 50 to 80 years, usually a country goes through a pretty large currency devaluation. And it's just a cycle that plays back literally all the way to ancient Greece. We have literature going back that it goes back to Rome, goes back to Greece. It just kind of keeps happening.
It just seems like legal stealing if you suddenly devalue the currency, and it's amazing how governments get away with that. It feels people have short memories, and this just keeps happening every time there is something big about to unfold, and that's what happened. But I'm curious. You said it is not necessary a choice. Some countries have maintained their currency strength over a period of time, say through equities. Can you talk a little bit more about it? What system do you feel can prevent such devaluation from happening from time to time?
So it depends on what you look at. And so, for example, during the 1930s devaluation, countries devalued at different rates. And so, countries that lost World War One ended up devaluing the most. And so, Germany, of course, had their famous hyperinflation in the 20s. But even among kind of, the rest of the nations, like the dollar devalued less than France's currency, and Swiss's currency devalued less than the dollar because they were the more fiscally robust at the time. And going back further than that, I mean, there were, the Florentine, that persisted as a an undebased gold coin for many centuries. And so there have been these environments where it really comes down to priorities. Some of these countries that have kind of made it a priority to maintain the stability of their currency have managed to either have it not depreciate or to depreciate slower than some of their peers. But it's kind of, it goes back to having a culture that really kind of looks for the long term rather than always trying to optimize the short term. And so there are ways, there are multiple levers that the combination of the people's habits and then the politicians that they elect and what they do, or if they're king even. But those policies can maintain stability in the long run. It's just very rare because it's kind of like a lot of things have to go right in order for these countries not to eventually have a big devaluation. At least statistically speaking, throughout thousands of years
Right.
of history.
Right. It just, I would imagine it takes a very long term view of whatever nation, country, or constituency you have to to make. All the incentives for at least politicians and kings point towards debasement. So I would imagine it takes a lot of strength to not do that, not sort of fall into those incentives.
Exactly. And I mean, the way we have incentives in our political systems is, if you're, no matter what, almost no matter what system you're in, if you're a king or a queen, you might be looking out 20, 25 years, right? You don't want to devalue in your reign, but you don't care if it you're allowed, you're able to like leave it in a state where it's kind of prone to devaluation, but not really devalued yet. So you can kind of push the limits. And then if you're running a democracy and you're having like a 4 to 8 year political cycle, you just have to make sure things don't blow up for 48 years. You want to give people what they want, and you don't really care what happens 20 years, 50 years down the line. And it's just one of the kind of the realities of human nature. And theoretically, if you had the people kind of putting those politicians into office, if they had a very long-term view, then the politicians would also have a very long-term view. But just in general, people want what they want now, and so we tend to be prone to these big cycles rather than having kind of a smoother outlook that we could have if we were kind of more focused on doing that.
Right. So coming back to Bretton Woods and how US dollar came to become the reserve currency for the world. So by that time, I would imagine a lot of these major currencies were getting devalued against gold, and one by one they just gave up their peg to gold. And US dollar was the last major currency which was still backed by gold. But I was reading somewhere, and you wrote that as well, that World War II played a big role in terms of why US dollar had an edge. Perhaps because US was the domestic territory of US was not bombed at all, and Europe and the major currencies of Europe were just in tatters. So is that one of the reasons why US dollar had an edge for the last remaining currency to peg with the gold, and that's why it became the reserve currency?
Yeah, that's a key reason. Because Europe, even the winners were devastated by the war. The losers were devastated even more. Japan was devastated. China was devastated by Japan. So Russia, they came out as a relative winner, but they were, the amount of blood and treasure they gave up to win their side of the war was immense. And the United States was, besides Pearl Harbor, we were mostly untouched domestically. And we came back, all of our manufacturing base that we used to fight the war was still in place. We were able to come back and repurpose it. And so we were in a very privileged position, in part because our geography just made us very separate from a lot of these issues. Combined with the fact that we were a pretty large population, and so at the time we were something like over 40% of global GDP was the United States, and so we were the largest commodity importer. And so, being the military might and the economic might, we had more of a reach in order to set the policies. And so we were able to, kind of, bully people essentially into accepting what we want, as long as it's at least somewhat in their interest, as long as we give them something like military protection, trade deals, things like that. And one of the problems over time, the reason the system's not really kind of permanently sustainable, is that as Europe recovered and Japan recovered, and then as we saw the rise of China and other emerging markets, the United States percentage of global GDP keeps going down. And so it started in the 40% range. By the time Bretton Woods system ended, we were still in like the mid 30s, like something like 35% of global GDP. But now, depending on how you measure it, it's somewhere between 15 and 25% of global GDP. Let's say 20%. And we're not even the biggest commodity importer anymore. And so China imports more commodities, for most commodities, than the United States does. They import more oil. They import more. They're like 50% of copper consumption pretty much goes to China, and yet they're still using the dollar for the majority of that. And so what we're starting to see over time is that the dollar is just not big enough to be the only currency that's used for global energy pricing anymore. Just our current account deficits, even as big as they are just not big enough for that purpose. And so, in addition, some of the countries don't want to play along with the having to go through the U.S. SWIFT system. Basically going through the financial plumbing in New York, and even though it's Belgium based, but basically they don't want to go through the dollar-based system because it kind of gives up some of their sovereign power over their currency. And so what we started to see, for example, is that Russia sold most of their treasuries, and began pricing oil in euros. And so they've been selling that to China. They've been selling that to Europe. So even China, for example, has been paying Russia in euros for some of their energy. And we've also seen China have an interest in being able to use their local currency to get some commodities. And so we're starting to see over time a more multipolar world where some of these other major currencies, like the euro especially, and then to a lesser extent the yuan, are starting to have some international trade relevance. And so I think the more likely outcome is that this will progress throughout the 2020s, where instead of the U.S. dollar being the only global reserve currency, it'll be one of several, maybe 3 or 4 large currencies that are kind of regional reserve currencies. And I think that's kind of the structure that we're shifting to.
Yeah. So I have a question on that, but before I come to that, I was curious, why did US want to push dollar as a reserve currency? What is there for a country to be a reserve currency? What was the pull?
Well, a couple things. One is, that we were ending one war, but we already saw that we were kind of going into the Cold War, and especially that was, when the system was refixed back in the 70s with the petrodollar system. That Cold War era was certainly kind of a big factor. Is that we wanted to maintain some degree of global reach rather than to pull back and become more isolationist and kind of focus on our own domestic economy. And so the global reserve status, it kind of has pros and cons because it makes your currency pretty strong. It makes it so that you can literally print money to buy hard goods around the world. You can literally, your paper currency, you can buy oil, it can buy cars, it can buy copper. It can, you can afford foreign military bases pretty easily. Your currency is just used around the world. It becomes the de facto currency, and so that's really big. In addition, those countries, that run structural trade surpluses with us, they take all these dollars and then they usually recycle the dollars back into buying our treasuries. And so we have, our trade deficits recycling back into financing our government deficits, which basically means that for a couple of decades we get a free lunch and we just kind of have this kind of infusion of capital. And so it's kind of like a blending of an emerging market and a developed market financing situation, because emerging markets are usually externally financed, developed markets are usually internally financed, whereas the United States has been a developed market that is still somewhat externally financed. And so it's kind of like the supercharging of our economy. And so that can work for a couple decades. But then over time, we start to have that trade-off where we have to basically we get all those benefits, but we have to ship out our manufacturing base because we're running these persistent trade deficits, and our manufactured goods just aren't very competitive. And so, we buy foreign cars; they don't buy the Germans don't buy American cars, for example. We buy German cars. Same thing, Japan. We have some exceptions like with Tesla, but even those are increasingly made overseas. And so that's kind of the pattern we've played out for a long time. And now that's starting to shift a little bit as well. And so, for example, when Europe was our biggest trading partner, I mean, they would recycle treasuries back into dollars back into buying our treasuries. And then we shifted more towards Japan, and we had the rise of Japan in the 70s and 80s and 90s. And then in the past 20 years, it's mainly been China. They ran really big trade surpluses with us. They took all their dollars. They bought over $1 trillion worth of treasuries. But then about 7 years ago, China stopped reinvesting their dollars into buying more and more treasuries. And they said, no, that's not in our best interest anymore. Instead, we're going to start using these dollars to buy hard assets around the world. So we're gonna buy oil interests in various countries. We're going to buy copper interests. We're going to make loans to kind of get paid back either in loans, or if they default on the loans, we'll get the infrastructure. So we'll get the reports. And so, China's kind of reinvesting those dollars instead of just buying more treasuries. And so really the United States no longer even benefiting from the system that it did benefit from throughout the 70s, 80s, and 90s. Now we're kind of just on the tail end of the system where we have most of the downsides, but few of the upsides.
Right. So what you're saying is, if I have convinced everyone to price whatever they want to buy or sell in my own currency, and I can literally print it, it's beneficial for me in the short term because I can keep printing and keep getting stuff that people have to sell. So I'm importing more and more stuff essentially for free in a short while. But after a while, people realize, that this is not going to work in the long run, because people just don't trust that you have that you'll stop, right? I mean, if you can literally print any amount of money, people will just stop holding any sort of trust in that currency, and that's what you're saying is happening and unfolding.
Exactly, yeah. And in that sense, short term still refers to maybe 30 years. And so that's one of those examples where, it can maybe an intermediate term decision. It can give us kind of a boost for a generation or a generation and a half. But when you start looking out 2 or 3 generations, that's when the prices start being paid. And so, the system felt pretty good, in the 70s and 80s. A little bit less good in the 90s, still pretty good though. But once you get to the 2000s and the 2010s and now the 2020s, that's when it's people both in America and elsewhere starting to realize, like, maybe this isn't in any of our best interests, that the system is just kind of outdated, is no longer working in really in anyone's favor, except for kind of a minority of people that maybe, if you're in the United States and you work in technology, finance, healthcare, or government, you're pretty much benefiting from the system because you get a lot of the upsides without really having the downsides. But if you work in U.S., any sort of blue collar work, pretty much any sort of industrial work, or if you're one of the foreign countries that don't really want to play ball in the system, those are the groups that it's not really working for anymore. And so over time, the groups that it's not working for keeps growing, and the groups that it's working for keep shrinking until it hits a breaking point.
And that is largely what Triffin's dilemma is. So help me. Uh, I'm not sure if I'm characterizing it right, but the way I understand is, if you are the world's reserve currency, you have to necessarily export the currency because everyone wants it for doing their trade. And in the process of that, you slowly erode your own competitiveness. And after a while, people lose trust in that reserve currency because there is nothing backing it. There is no hard asset, and even the economy's competitiveness has gone down, and the system sort of implodes in itself.
Yeah, pretty much. I mean, Robert Triffin was an economist, and he testified to Congress that back in the day that the Bretton Woods system would eventually fail. and he explained why. And basically, there's a couple different versions of the Triffin dilemma. But back then, it was basically that we would run a persistent capital account deficit, and it would kind of go back to that problem of just too many dollars compared to the gold we have, and that therefore we would draw down gold until the system wouldn't make sense anymore. And so then that's exactly what happened. Now, ever since the petrodollar system, which was kind of a reconstructing of the global reserve status, that also reconstructed the Triffin dilemma. And so basically that made it into that we would run persistent current account deficits, which is like trade balance plus investment income, things like that. So you basically can call it a trade deficit. We would run persistent trade deficits, and instead of drawing down our gold, we would draw down our industrial competitiveness and our manufacturing base to maintain that status. And so basically, ultimately, the Triffin dilemma goes down to kind of, on one hand, you want to manage your currency for the domestic economy, which is what most countries have to do. But if you're also the global reserve currency, you have this foreign factor that affects it. And the famous line, something like 50 years ago was it's our currency, but your problem. And so it doesn't matter if a foreign country can't get enough dollars to buy oil. It's who cares? We're the empire. But over time, it starts to become our problem as well, because, for example, we saw in March of last year, March 2020, when we had this big, this big global shutdown from the pandemic, we started to see some of these countries, they have all these dollar-based debts, right? So you have emerging markets around the world, they owe debt in dollars. And so they're reliant on constantly dollars circulating the world. They need dollars for trade in order to keep servicing those dollar debts. And so what happens when you shut down the global economy for a month and those dollars dry up, but you still have those dollar-based debts? Well, what happens is that a lot of those countries build up assets over the decades of running trade surpluses with us. And so, for example, at that time, if you look at the net international investment position, the rest of the world owned something like $42 trillion worth of U.S. assets. That includes treasuries, that includes corporate bonds, that includes stocks, that includes real estate, all sorts of U.S. assets. And they also owed about 13 trillion in U.S. Dollar-based debts. And most of that wasn't even owed to the United States. In fact, virtually none of it was. It's mostly owed to banks in Europe, banks in Japan, China, all sorts of kind of different international things. But the point was they were dollar-based loans. And so what happened was when you had that spike in the dollar, because everybody needed dollars to service their loans, but there weren't enough dollars circulating around. So what do they have to do? They have to sell their US-based assets. So they start selling treasuries, which are the most liquid. And we saw, foreigners sold maybe $200 billion worth of treasuries in like a month. And basically the treasury market became illiquid and pretty much broke, which is, kind of, you're not supposed to see that happen, because that is supposed to be the deepest, most liquid market in the world. And so the Federal Reserve had to have a, emergency meeting on a Sunday and then come in and buy $1 trillion worth of treasuries with new money in 3 weeks in order to reliquify the treasury market. And so those are the problems you start to see when your currency is no longer big enough to be the global reserve currency, and when you have tons and tons of debt relative to the amount of that currency that exists.
So what you're saying is, say in March 2020, um, uh, because of economy slowdown, there was not enough dollars coming in because the trade was sort of halted, and a lot of countries across the world had to sell treasuries, and there were so many treasuries being sold, there were not enough buyers, and Fed had to step in and buy
Exactly.
a lot of those, and that
Yep.
sort of set the foundation for this recent surge of quantitative easing that's happening. So your thesis about US dollar weakening, is it primarily because there's lots of more US dollar in circulation and lots more to be expected, or it's because people are trusting dollar less and less over time, or it's both?
It's a little bit of both. And so it's more the first one. And so if you look back in history of the petrodollar system, since this free floating exchange rate system, there have been
Right.
three
So,
major cycles.
Lyn, can you describe petrodollar? I'm not sure a lot of listeners would know what petrodollar is and how it came about to be.
Sure. A petrodollar system is what I referred to before, where in the mid 70s, the United States made a deal with Saudi Arabia and OPEC to only price their oil in dollars. And so, before then, the dollar was mostly backed by gold. And so that's how it worked. It was pegged to gold. But when that system broke, ever since the mid 70s, we've essentially been backed by oil. And it's not that we've been pegged to oil. It's that because all countries in the world need oil, and oil is only available if you can pay in dollars, we basically made it so that all countries need to work with the dollar in some way. And so that's the petrodollar system as it's been structured for about 45 years. And so that's the system we're in now. And during that time, exchange rates have been floating because they're not all, currencies are not pegged to the dollar anymore. And so if you look at the dollar compared to a basket of foreign currencies, it has these big, it looks like a sine wave that goes up and down over time. And a lot of that is based on what the fiscal and monetary policy of the United States is. And so in the early 80s, when Paul Volcker, or the Fed chairman at the time, raised interest rates and basically ran a really tight monetary policy, at the same time as President Reagan was running pretty loose fiscal policy because they were running large deficits, that squeezed and basically made a very strong dollar. And so we saw a spike in the dollar from 1980 to 1985, where the dollar became very strong relative to other currencies. And then we saw the Plaza Accord, which was the United States, basically made a deal with foreign countries, Japan, Germany, Britain, and France, to weaken the dollar. They would all basically, work together to weaken the dollar versus those currencies, especially against the yen. And so then the dollar sharply fell, but it started to build up again in the later half of the 90s, because we had this economic boom. We were, basically the United States was kind of the peak of U.S. exceptionalism. And so we started to get more and more kind of money flowing into the U.S. And we had a strong dollar period. And the problem is every time the dollar gets strong, it squeezes all of these countries that have dollar-based debts. And so in the 1980s, when we had that dollar spike, the victim was Latin America. And so Mexico and a lot of these other countries basically had to blow up their finances because their dollar debts became unpayable. In the late 90s, it was mostly Southeast Asia. And so you saw Thailand, South Korea, Singapore was affected indirectly, Malaysia, and then Russia as well. And so you saw multiple of these countries kind of run into problems. And that results in slower global growth. That, of course, affects U.S. growth as well. And then, we have a recession, and the Fed ends up having to cut interest rates, run a more dovish monetary policy. Usually we get more fiscal spending. That puts more dollars in the system. So we get a weakening dollar. And so throughout the early 2000s, we had another down leg in that dollar cycle. But then, in 2014, quantitative easing ended. And so basically the Federal Reserve shifted from very, very loose monetary policy back to relatively tight monetary policy, at least compared to the rest of the world. And so what we saw from 2014 to 2015 was we re-entered a strong dollar environment. And we've been in that period pretty much ever since, where we have a relatively strong dollar compared to other countries. But starting in late 2019, when the Federal Reserve began increasing its balance sheet again, and then when it cut interest rates and it accelerated the balance sheet increases in 2020, that weakened the dollar somewhat. And so it really comes down to roughly, how loose the central banks are being with their currencies on a relative basis, and whether or not there's tightness in foreign dollar markets. And so what we've seen recently is that we've seen a pretty sharp decline. But we have these periods where it kind of tries to bounce, and we saw that happen in the summer of 2020. We saw a little bit of a stability and a little bit of a bounce before it went a little bit lower. In addition, now in the past month or so, we're seeing another dollar bounce where it seems to try to be regaining some degree of stability. And what it'll come down to, I think, over time is a couple different factors. One is that as long as the dollar stays where it is now, probably the United States and the rest of the world will have trouble kind of recovering to some extent. And you'll see more and more fiscal stimulus by the United States until that's enough to weaken the dollar again. But it can always be a choppy period. And so I think, as long as you have the combination of a loose fiscal policy while also having loose monetary policy, that tends to be the recipe for currency weakness. Whereas if you have tight monetary policy, even if you have loose fiscal policy, that tends to be pretty strong for a currency. And so that's kind of how I'm looking at it. But then longer term, when you look at that, what I said before about multi-currency energy pricing, we start to have this chipping away at the petrodollar system. We start to have the petro euro and the petro yuan. That can reduce the amount of that foreigners need dollars for things, and you kind of diversify the type of currencies they use, and then you can start to get a somewhat weaker dollar over time. And so that's kind of how I'm viewing it.
Yeah. I mean, what I find amazing is US domestic policies have worldwide repercussions. US decides to do something and multiple countries go into recessions and depressions. um, but what you're suggesting is that's not good for, I mean, a strong dollar means developing countries have to work harder to service their debts, and that has, because economies are interlinked, that causes a downturn in US as well. So all the incentives point to dollar not being very strong, but over a long period uh, actually weaken. I was curious, what are your views on its long-term implications? I think a lot of people talk about inflation. If there is a lot of quantitative easing happening, inflation could kick in. But historically, at least, consumer inflation hasn't been that much. So where is this extra dollars going, and why inflation is not happening? And I know you've been recently talking about Japan as an example as well. So Japan also didn't see a lot of consumer inflation. So yeah, what are your views on this weak dollar having implications? What sort of implications?
Yeah, so the biggest variable for inflation is broad money supply. And so when we define what money is, the funny thing is it's actually hard to define because there's so many layers of what money is. And so we have, for example, base money, which is currency in circulation and bank reserves that the banks hold with the central bank. And that's basically wholesale money. That's kind of the foundation of money. And that's actually a pretty small component of the total money in the system. And then so on top of that, banks then they make loans, they accept deposits, and they basically multiply that base money. And so, for example, in the United States, our base money is something like 5 trillion, whereas our broad money is nearly 20 trillion. And so it's about 4 times bigger than base money. And that includes checking accounts, that includes savings accounts, that includes CDs, all the things that you and I would consider our money. In whatever country we are around the world, that's broad money. That's the money that we have. And if you just see an increase in the base money, so the central bank increases their balance sheet, that generally doesn't necessarily result in an increase in the broad money. It's not like I have more money. It's not like you have more money just because the central bank increased their balance sheet. Now, that has some implications, but usually broad inflation is not really one of them. Now, what does tend to be highly correlated with inflation is broad money supply inflation. And there's really only two ways that broad money supply goes up dramatically. Either banks have to lend a lot and therefore create more broad money, or you need quantitative easing combined with very large fiscal deficits that direct that quantitative easing directly to us. And so, for example, if the government sends me and you checks and then sends us more checks and then sends us more checks, then our bank accounts are actually going up. And therefore, that actually can affect our spending. And so, if you look back over the past century, for example, in the United States, we've had 3 decades where broad money supply has gone up pretty significantly over say a 5 to 10 year period. That was the 1940s, which is very inflationary. It was the 1970s, which was very inflationary, and it's just starting to happen now over the past 2 to 3 years, where the broad money supply is starting to go up pretty significantly. Now, if you look at the 2010s, even though we had quantitative easing, so we had the base money supply going up a lot, because we didn't have very large fiscal deficits, we weren't sending out checks to people, we weren't doing things like that, we weren't doing giant infrastructure projects or anything. That really didn't affect the broad money supply. We were still kind of growing broad money supply at maybe 5% a year, so it wasn't very remarkable. The same thing happens for Japan. If you look at Japan over the past 10, 20 years, even though everybody likes to look at their central bank balance sheet because it just goes vertical. They've done more quantitative easing than pretty much anyone else, but it hasn't translated into broad money supply because they haven't had banks lending, they've had corporate deleveraging, and their biggest deficit was like 8% of GDP. So it's not like Japan is sending, at least prior to 2020, they weren't just sending tons of money to people. And so those periods of just rising the base money is not inflationary. It's kind of anti-deflationary. It recapitalizes banks. It can potentially boost up asset prices. But what's really kind of inflationary in for consumer prices tends to be a broad increase in the money supply combined with some degree of commodity shortage. Because if you have abundant commodities, you're still not necessarily going to get inflation. But if you have broad money supply combined with going up a lot, combined with some degree of commodity scarcity due to a lack of investment in recent years, that's when you get pretty sharp inflation typically.
Right. So what you're suggesting, what you're saying is, if Fed increases their balance sheet, that creates a potential for broad money supply to increase, but doesn't necessarily imply that and until because of fractional reserve system, and until that happens, inflation wouldn't happen because that potential hasn't been tapped. So unless the government spends more, send people's checks, just increase of that central bank balance sheet doesn't kick in inflation, and that's what has happened in Japan.
Yeah, pretty much. And if you look at even just last year as an example, in 2020, we started to see for the first time broad money supply in multiple countries going up rapidly, and that's because we combined massive quantitative easing with fiscal expenditures to kind of inject that money into people's pockets. But we didn't see it at the same kind of spectrum around the world. There's different magnitudes. And so the United States, we increased our broad money supply by 25% in 1 year, which is you'd have to go back to the 1940s to find a year where we increased it by that much. Then if you look at the Euro area, or if you look at Japan, they increased theirs by 10, 12%, something like that. So about half the rate that the United States did. And so it's not surprising that 2020 was a sharp year for dollar devaluation, because the dollar index went from, depending on what your starting period was, it went from the upper 90s, it peaked in the lower hundreds, but it fell all the way to like 89, 90. And that's because we increased our liquidity, increased our amount of dollars in circulation far more than them. And so going forward, I think the big question is who's going to increase their broad money supply at the fastest rate. And so, if your analysis suggests the United States will, which I think it does, then probably the United States dollar will devalue more than or at a quicker pace than some of those other major currencies. But that doesn't mean it necessarily does it every single quarter. It's not like it just goes down a straight line. But if you look at over, say, a 3 to 5 year period, I do expect the United States to devalue the dollar more. And another thing to look at is that, Europe and Japan have current account surpluses. And so there's more money flowing into those countries than flowing out of those countries in a given year. Whereas the United States, we run, because of things you mentioned before related to the, Triffin's dilemma and the petrodollar system, we run structural current account deficits. And so when we do have weak, loose monetary policy, ours tends to have that weakening effect more. And so I do think that over the next 3 to 5 years, we're probably looking at a weaker dollar, and really kind of weakness in currencies globally, because most of them are paying negative real yields, meaning that their interest rates are zero or negative, while inflation is typically higher than their interest rates. And so, anyone holding cash or sovereign bonds is generally losing money slowly compared to hard assets like gold or other assets. But of course, in a given quarter, some of those other assets can be more volatile, which is why some people still like to hold those cash and sovereign bonds. But it becomes kind of a danger if you hold a lot of that too heavily over, say, a 5+ year period.
Right. So what you're saying is different currencies, almost all the currencies are devaluing, but it depends which ones devalue the fastest. The sort of trend in and the pace of devaluation could be different for different countries. And if US government start spending a lot, then US dollar could devalue much faster. So I was in fact about to ask you, when you mentioned in terms of stocks and hard metals would retain their value, but generally speaking, who benefits and who loses from a weak US dollar?
So a weak US dollar would primarily benefit a couple different groups. So one would be commodity producers, because most commodities are still priced in dollars. And so if you have a much weaker dollar, you tend to have higher prices in those commodities as priced in dollars. And so that benefits oil producers, copper producers, iron producers, pretty much across the board, unless their particular commodity has some sort of issue that, say there's oversupply relative to demand or something. But if you're a broad commodity producer, you generally do pretty well. Emerging markets tend to be very big beneficiaries of a weaker dollar. Because, they have, it depends on the country, but a lot of them have a large amount of dollar-based debts. And so that effectively, devalues their dollar relative to their productive capacity. And so it's kind of like, if the dollar strengthens, it's kind of like quantitative tightening for them. It's kind of like a tight monetary policy. But when the dollar weakens, it really kind of loosens them up, and they can be prone to more of an economic boom. And so, some of the biggest emerging markets, runs were in the late 80s, and then again in the 2000s, when the dollar was kind of on the down leg from its previous high. Those tended to be good for emerging markets. And if you look over the past If you look at emerging market indices since inception, so if you look at the MSCI Emerging Market Index going back to 1987, and if you look at the earnings, especially the cyclically adjusted earnings, whenever you have a strong dollar period, usually their earnings go flat and choppy and even decrease. And when you get a weaker dollar, you get another leg higher in their earnings. And so we've been in this kind of 5-year consolidation for emerging markets. And so if you were to get a weaker dollar, it probably would benefit a lot of them pretty significantly. And then ironically, it would likely benefit the United States in the sense that if you look at a chart of the US dollar relative to other currencies, and you look at US corporate profits, again, every time we have the dollar hit a spike, we get a flat line in corporate profits as priced in dollars. And it's partly because our exports become even less competitive because our dollar is so strong relative to other countries. And it's because when the whole globe slows down because they're all squeezed by the dollar, that affects a lot of our companies. And it doesn't necessarily affect a company like Amazon, right, because they're growing anyway, but it affects a lot of our cyclical and industrial companies. And so you can start to get, if you have a weaker dollar, you're more likely to see kind of value stocks come back. In this strong dollar period, it's been very good for growth stocks because they're less affected by it. But if you get that weaker dollar, then probably some of those more cyclically sensitive stocks, the more the value stocks or the cyclicals, they would probably benefit from that as well. And it gets a little bit tricky for places like Europe, because on one hand, a stronger dollar could make their exports to the United States less competitive. And so that could be a little bit of a headwind against them. However, they also have a large export market to emerging markets. And so if emerging markets are booming, that can benefit Europe. So overall, I would view a weaker dollar as kind of neutral for Europe. It kind of depends on who you are in that particular country. If you're primarily exporting to the United States, it's generally not great. But if you're exporting to emerging markets, or you're just kind of in general kind of have multiple areas of interest, it can be pretty beneficial. The people that it tends to hurt would be anyone holding a lot of dollars. And so if you have a lot of cash in the bank, if you own a lot of U.S. Treasuries, those are the entities that would generally be harmed by having a weaker dollar.
Right. And Lynn, you talk about that these are two separate concepts: dollar devaluing and dollar not being a global reserve currency. In what ways are they connected? I know you talk about them being separate but still being connected. I'm interested in knowing how would dollar weakening influence dollar status as a reserve currency, or may not influence.
Yeah, so a lot of people view them as the same thing, which is a mistake, because if you look over this, 45-year period of having floating exchange rates and the petrodollar system, the United States, the dollar has, as I mentioned, had these big moves. And so, the dollar devalued 45% or so in from the mid 80s to the late 80s after the Plaza Accord, and we still maintained our currency reserve status. And then again, we devalued another 40% from the peak in 2002, 2003 down to the bottom in 2007, 2008, 2009, that period. And so that didn't really affect global reserve status. Now, so that weakening dollar, you can have a strengthening or weakening dollar without affecting the long-term viability. The longer-term thing to look at, in my view, is what happens with global energy pricing, because that's more structural. That's something we haven't really seen over the past 4 decades. So we've seen it in some rogue countries. So for example, Iraq priced oil in euros for a couple of years, but then they got invaded, so that they quickly went back to pricing oil in dollars. And we've seen a couple other of these kind of smaller rogue nations price oil in dollars. But now that we have Russia doing it, and they're one of the biggest oil producers, and of course their military is such that the United States can't really do much about it other than sanction them. We kind of fret about the Nord Stream 2 pipeline that Russia and Germany are building. We kind of play this little political chess, but there's not really a ton we can do about it other than complain. And so if we keep moving that direction, where big players like Russia and India and China, if they start being interested in either selling oil in euros or buying oil in euros, or whatever the non-dollar currency happens to be for the different countries, that can start kind of chipping away at dollar reserve status. And again, that would have pros and cons, because even for the United States, that would benefit the domestic industrial sector. And so the ones that have kind of sacrificed the most over the past 50 years would benefit the most, whereas the ones that benefited the most from the system would likely be harmed the most by that change. And so it's even then, it's not really, people often assume that losing the global reserve status would be bad for the United States. But because of all the sacrifices we make to maintain it at this point, it really depends on who you are in that system. And so that would basically it would decrease the United States' reach as an empire in that sense. It would basically give us less hegemony. But the benefit we would get if we managed it well would be potentially a more vibrant domestic economy. And so it's kind of that trade-off between how much foreign reach you want versus how much you want to focus on your own domestic economy and be a little bit more isolationist, similar to way that most other countries are. And so I think that's going to be a challenging thing to navigate politically. And they could mess it up because if you keep trying to maintain empire status and you just can't, then you could also fail to have that domestic vibrancy. But if they play their cards right, most sectors in the United States can also benefit from that, and we go towards a more balanced system that looks more like what the Bancor would have been if that was enacted in the 1940s. Kind of that there's no single currency at the center of the whole system, but that instead you have multiple currencies that kind of underpin the system.
Where would you place your bets in terms of US trying to maintain global reserve currency or trying to accelerate its desire to not be a global reserve currency?
So currently they are fighting against it, and so we saw, multiple U.S. politicians were writing nasty letters to Germany about the Nord Stream 2 pipeline, right? So just because Russia and Germany want to build a pipeline, uh, basically the United States is taking that as an affront to them. They say, we're funding NATO, we're doing all this. We don't want, we see that Russia is increasingly pricing oil in euros, and so we were pushing back against that pretty hard. Now it's unclear how this current administration will change that. I doubt we'll change it significantly. We are starting to see it's kind of going around us anyway. So whether or not we like it or not, we're starting to see China and Russia and some of these other big countries start to go around the system. We even see, for example, if you look at the trade between Russia and India, that's increasingly outside the dollar system as well, even though India is more of an ally to the United States compared to China or Russia. And just because it's just in multiple of these countries' best interest. Same thing as Europe. Europe, even though they're for the most part an ally with the United States, they still have an interest in being able to use their euro to be able to buy oil and gas, and if they want to trade with Iran, they can do so. And so it's I think the United States is going to fight it for a little while, but I think it's going to be one of those things where something breaks and then they have to reverse course. And so the Federal Reserve, for example, in 2018, they wanted to reduce their balance sheet, and they said we're gonna reduce our balance sheet on autopilot. We're gonna keep doing quantitative easing. It's gonna be like watching paint dry. And then eventually the market freaked out. So in Q4 2018, the S&P 500 fell 20%. There were no junk bonds issued in 6 weeks. There's just like the credit market froze. Most people were focused on the equity markets, but really kind of professionals were focusing on the credit markets, just totally freezing. Growth stocks in many cases fell 30% or 35%. And then Powell, in a press conference is basically like, we're just kidding. We're going to be data dependent. We're going to change as needed. And that kind of relieved the market. And so, the Fed can have all these plans and then the market just says, no, we're going to do something different. Same thing, happened in when we had the repo spike in late 2019, the Fed said, we're going to keep doing quantitative tightening. And then the repo spike happened. So the interbank lending rate overnight blew up, and the Federal Reserve had to come in and just permanently begin expanding its balance sheet in order to fix that. And so I think we're going to see it play out in such a way that the United States is going to try to maintain it, but that every once in a while something breaks and they have to take a step back. And every time they take a step back, that's when these other countries can keep building their systems and keep building these structures. And it's going to be kind of a multi-year process through the 2020s.
Right. So, irrespective of how hard US tries, the system itself is unfolding so that dollar doesn't remain the global reserve currency. So the natural question arises, what replaces this reserve currency status? I know one of your theses is that there could be a basket of currencies, and on that, I was curious, what are your views on what does that imply for different central banks across the world? I mean, traditionally they've managed their balance sheets in dollars mostly, but now if they have to manage in different currencies, a basket of currencies, does it make things better or worse, or what are the implications of dollar not being a reserve currency anymore?
Yeah, so there are a couple of different ways the system could look like. And so the simplest way would simply be that we continue the progress of what I just talked about, which is that individual large currencies begin used to price oil. And so Europe, for example, can buy oil in euros, and then therefore they don't have to hold as many dollars in their reserves. And so, they don't have to be as focused on that. Same thing with Russia. I mean, they hold more euros than dollars now as their reserves. You can see China, for example, if because they're buying oil from Russia in euros, they could hold a little bit more euros and kind of diversify their holdings a little bit. And so you start to have these regional areas where some countries might hold more um, of the currency that they mostly deal with. And so, for example, for Russia, it would make sense to hold euros and maybe to some extent yuan as well, and less sense for them to hold dollars, and which is exactly what they've done. And same thing with China is that they can diversify their holdings a little bit. And so that'd be my base case, is that just instead of one big currency, they'd have multiple. And to some extent they already do. And most central banks have multiple currencies in their reserves. It's just that the percentage is very tilted towards the dollar. And so you could see that just dial back over time and be a little bit more balanced, where even the United States dollar might even still be their biggest holding in many cases, just less of a percentage than it is now. But then of course, if you're like Russia, then it's pretty much near zero. And so it really depends on who your biggest trade partners are.
Right.
And from there are a couple more complex systems they can do. And so if we go back to the debate in Bretton Woods between the bank war and the dollar at the center of the system. So of course the dollar won, but we kind of saw a resurgence of the bank war in the late 60s when the IMF introduced the special drawing rights. And so this was a unit of accounts that central banks could hold, and it represents a basket of foreign currencies. And so the dollars in there, the at the time, the German mark and the yen. Of course, now it's the euro in there. And so you have this basket of these major currencies in the SDR. And so, there are even some countries that pegged their currency to the SDR. And so for this was kind of a thing for a while. It was always on the side. It was always a smaller thing. But that was kind of a system that kind of tried to replicate the Bancor idea. It just never really took off. And so if you were to get enough kind of agreement between countries, you could do something like that at a broader level. You could have just the SDR or something like a digital version of it play a larger role. And we've seen, for example, Mark Carney, the former head of the Bank of England, he's talked about that idea. There are some countries that are open to that idea, but I'm skeptical of that idea just because I think that the probability of multiple countries working together to be able to do something like that is pretty low. And so I generally default to seeing a message situation of just kind of multiple regional global like reserve currencies. And we've also been seeing, for example, central banks have been more interested in holding gold because it's kind of this neutral currency that's kind of inherently inflation adjusted, and they kind of hold that as part of their reserves as well. And so my kind of default case is just this more decentralized way, primarily based on what their biggest trading partners are.
Right. I would imagine that would be more efficient than just holding a large percentage as dollars, simply because you're less dependent on US domestic policy, and also perhaps that lead to some sort of a competition between monetary policies of different countries, and maybe the more efficient ones will see their strength as a more reserve currency. So do you also hold a similar view, having more options as a reserve currency is generally a good thing, or?
Yeah, I think so. I mean, I think the bank war would have been a healthier idea than the dollar system was, but the dollar system won out. And I think if we shift in some way to a multi-energy pricing system and a more diverse reserve system, I do think that's a more economically sustainable situation for the world, and ironically for the US as well, because we would stop sacrificing our domestic situation in order to maintain our status. And so I think over the long run, that is kind of the healthier and more mathematically balanced approach. It's just that during that transition, there are winners and losers in the mix.
Right. And what about, say, a cryptocurrency like Bitcoin? Could it also eventually become some part of reserve?
Yeah, potentially. In a similar way that gold, because Bitcoin is, it's inherently scarce and it's permissionless. And so we've actually already seen some usage of it by some of these rogue states that don't really have a ton of options. And so, for example, Iran has been exploring the use of Bitcoin because in addition to just holding it, they can use it as a payment system because they've been cut off from Swift. They've been cut off from some of these global payment systems. And so Bitcoin represents a way that they can potentially trade with someone, and there's no entity that can shut down those payments. And so, if Bitcoin were to get big enough, you could see some of these central banks, especially you're starting with some of these smaller ones that are kind of, outside the system, they could start to use it. Now, whether or not it ever gets on the balance sheets of really large central banks, I think is an open question. I think Bitcoin would have to be a lot bigger in terms of market capitalization in order for something like that to happen. But I think down the road, that's certainly an option. I mean, if I were running a central bank, I'd probably want a non-zero Bitcoin position, even if it was 1%. So in addition to my gold stockpile and then some of my more liquid, foreign currencies, I would certainly want a non-zero Bitcoin position in there as well. But it remains to be seen, whether or not they will, and kind of how long it would take, even if they do.
Great. Uh, Thanks, Lyn. I think this has been a wonderful conversation. We've touched on a lot of topics. I will link your different articles that you've written on this topic in the podcast, and also mention your Twitter. You have amazing insights on what's happening in the world. So everyone, highly recommend to follow Lyn. And I thank you for your time today and all the insights you gave today.
Yep. Thanks for having me.
Thank you. Bye-bye. Take care then.
Bye.